Welcome back, everyone. Ready for another deep dive?
Absolutely. Always excited to dig into some new material.
Well, today we're taking a look at some letters written by Nick Sleep.
Oh, yeah, the Nomad investment partnership guy.
That's him. He consistently beat the market for over a decade.
Impressive track record. So what? We're talking like stock tips and secrets.
Not exactly, but kinda. These letters, written to his partners between, I think it was 2001 and 2014,
Okay.
they offer this incredible glimpse into his investment philosophy,
Interesting. So like we're getting into the mind of a master.
Exactly. And what makes it even more fascinating is that these letters, they weren't meant for public eyes.
So it's like we've stumbled upon some hidden treasure trove of wisdom.
Right. Sleep and his partner, Koi Zakaria, they ran Nomad differently. It was closed to new investors for a good chunk of its existence.
Exclusive club. So these letters are like unfiltered, raw insights.
That's what we're hoping for. It's like eavesdropping on a conversation between two brilliant minds.
Sign me up. I'm always up for decoding the secrets of successful investors.
Well, that's our mission today. Trying to understand what made Sleep so successful and seeing if we can apply any of his strategies to our own, investment journeys.
Makes sense. So where do we even start with a guy like this? What's the core of his philosophy?
Well, one of the first things that jumps out is his focus on long-term value creation, like really long-term.
We're not talking day trading here.
Definitely not. He wasn't chasing quick profits. Instead, he looked for companies with sustainable competitive advantages. Those built to last.
The kind that can weather any storm.
Exactly. And get this, Nomad's average holding period was 260 weeks.
Whoa, 260 weeks. That's like 5 years?
Yeah, 5 years. The average investor holds stocks for 20 weeks.
Something like that. Makes you wonder who's really playing the long game here, huh?
Right. It's a totally different mindset. Now, one of Sleep's key models, it's called scale efficiencies shared.
Scale efficiencies shared. That's a mouthful.
It sounds complicated, but it's actually pretty simple. He looked for companies that could grow, right? But at the same time, they were consistently passing savings on to their customers.
So it's like a win-win. The company gets bigger and more efficient, and the customers benefit from lower prices.
Exactly. Everyone wins. Think of it like, Amazon Prime.
Oh yeah, Prime's a perfect example. Free shipping, streaming, all that stuff for a pretty low price.
Right. They can do that because they're huge and efficient. They've got this massive scale. It's scale efficiency shared in action.
And Sleep believed that this ultimately leads to a stronger business, right?
Totally. By putting the customer first and focusing on long-term value creation.
It builds loyalty.
Absolutely.
Right.
They create this loyal customer base and this powerful competitive advantage that's hard to beat.
Smart. So who did Sleep see doing this wrong?
Well, he often contrasted this approach with companies like Coca-Cola and Gillette. He felt they prioritized short-term profits, constantly raising prices without really adding much value.
Just squeezing every penny they can get?
Yeah, he called it harvesting. Imagine a farmer picking all the fruit at once.
Instead of letting some grow for next season? Yeah, I get it. Short-sighted, unsustainable.
Exactly. And Sleep argued that this harvesting mentality, over time, can erode a company's advantage.
Sure, might make a quick buck, but could alienate customers in the long run, right?
Right, and stifles innovation. Okay, let's switch gears a bit and talk about another one of Sleep's investment models. It's called a deep discount to replacement cost.
Deep discount to replacement. Okay, break that down for me.
So picture this. You could buy a fully functional factory, everything's there, ready to go, but for a fraction of what it would cost to build a brand new one.
Okay, that sounds like a bargain hunter's dream.
Yeah.
Finding hidden gems.
Yeah. And Sleep was willing to buy companies that were so undervalued that their market price was way below what it would cost to rebuild them from scratch.
Interesting. Do you have an example? What kind of companies was he buying on the cheap?
Well, one that really stands out from his letters. It was a cement company in Zimbabwe called Zimsham. And he bought it for, get this, 170th of its replacement cost.
Zimbabwe. Wait, wasn't that, super risky with all the economic and political turmoil there?
Oh, it definitely was. It was a total contrarian move.
Bold. But Sleep saw value where others saw only danger.
He did. He believed that the company's intrinsic worth, based on its assets and potential, was way higher than its market price, even in that really tough environment.
So he wasn't afraid to go against the grain. Huh. That's a theme we're seeing a lot with him.
Definitely. That contrarian thinking, it's a hallmark of his approach. always looking for opportunities that everyone else missed.
Makes you wonder, how many of us would have the guts to do that? Buy when everyone else is selling.
It's a tough call. Now, this leads to another key element of Sleep's philosophy. It's concentration over diversification.
Wait, so he wasn't all about spreading your risk.
Not the traditional sense. He didn't believe in spreading your investments thin. He was all about making a few very calculated, high-conviction bets.
So more like putting your eggs in a few carefully chosen baskets.
Kind of. He challenged that whole don't put all your eggs in one basket wisdom. He argued that owning more stocks doesn't automatically lower your risk.
Especially if you don't really understand what you're buying. Right.
Exactly. You need the knowledge to properly evaluate each company. And true diversification, he believed. That's what index funds are for.
Interesting. So depth over breadth.
Yes. It's about having a deep understanding of a select few companies rather than the superficial knowledge of a whole bunch of them.
I can see how that ties back to his emphasis on patience, too.
Right. Holding those investments for the long haul.
Writing out the ups and downs and letting those returns compound over time.
He actually compared it to the bond market. He suggested that, like how longer-term bonds offer higher yields. He thought returns increase with time in the stock market, too. He even called it the equity yield curve.
Equity yield curve. Never heard that one before. But it makes sense, It challenges that whole idea of constantly buying and selling for quick gains.
Yeah, Sleep was definitely playing the long game. But it wasn't just about numbers for him, though, right?
Oh, absolutely not. He was also really tuned in to the importance of company culture.
That's right. He was drawn to founder-led companies with strong, cost-conscious cultures. He believed a company's culture could tell you a lot about its long-term success.
Culture's everything, right? It sets the tone for everything a company does.
And there's that great story about Amazon taking the light bulbs out of their vending machines to save money.
Classic. That's the kind of frugality that Sleep admired. Those little details can reveal a lot about a company's commitment to efficiency and long-term value creation.
It's a good reminder that sometimes the simplest actions speak volumes. It's amazing how those small things can give you a peek behind the curtain, right? See what a company's really about.
Absolutely. It's got a little window into their soul. But, even with this meticulous approach, even Sleep must have stumbled a few times, right? Made some bad calls.
Oh, for sure. Nobody's perfect, right?
Yeah.
Even the best investors make mistakes.
Did he ever talk about that in his letters, like how he dealt with those missteps?
He did. He was actually pretty open about it. He believed that mistakes, they're inevitable. It's part of the game.
That's refreshing, actually. Not many people like to admit when they're wrong, especially in the world of finance.
But Sleep, he saw it differently. He believed that the real skill is in learning from those mistakes.
So it's not about avoiding mistakes altogether, but about how you bounce back.
Exactly. And he was big on recognizing those cognitive biases that can trip us up, the mental traps that can lead to bad decisions.
Oh yeah, those pesky biases. We all have them, lurking in the shadows of our minds.
Right. And he was constantly urging his partners to question their assumptions, be open to new information.
To be willing to change their minds when the facts changed, even if it meant admitting they were wrong.
Yeah, he even quoted Tallulah Bankhead, the actress. She famously said, "If I had to live my life again, I'd make the same mistakes, only sooner."
I love that quote. It's like, yeah, I messed up, but I learned from it, and I'll do it faster next time.
It shows that he really embraced that whole learning process. Mistakes are just part of the journey. So what were some of those biases that Sleep warned against, the ones that he really saw as dangerous for investors?
Well, he talked a lot about three in particular: denial, anchoring, and drift.
Denial, anchoring, drift. Okay, break those down for me. What do they look like in the real world?
So denial is basically pretending a problem doesn't exist, because the truth is just too painful to face.
Oh, yeah. Burying your head in the sand.
Exactly. Anchoring is holding on to an old view of a situation, even when new information suggests you should, update your thinking.
Stuck in the past.
Yep. And then there's drift. That's letting small, seemingly insignificant changes in your thinking, they snowball into big errors over time.
It's like the boiling frog analogy, right? Slowly turning up the heat until it's too late.
Yeah, a gradual shift that can lead you down a dangerous path.
Oh, that's really insightful stuff. It's like he's giving us a map to avoid those common pitfalls.
Totally. A guide to navigate the treacherous terrain of our own minds. And it's a reminder that these biases, we all have them, even the smartest, most experienced investors. The key is to be aware of them, right? Actively work to mitigate their influence.
It's not just about being smart, but also about being self-aware.
Exactly. Now, this brings us to another area where Sleep really went against the grain. His take on institutional investors.
Oh yeah, he wasn't shy about criticizing the big guys, was he?
Not at all. He called it institutional dysfunctionality. He argued that the rules and incentives for these big institutions, they often lead to bad decisions.
So the system itself is rigged against them.
In a way, yeah. He was especially critical of this obsession with liquidity. He believed it forced institutions to sell stocks even if they were undervalued, just because they weren't trading frequently enough.
So they're prioritizing ease of buying and selling over potentially holding on to a valuable asset.
Right, and that creates opportunities for investors like Sleep, the ones who were willing to be patient and hold on to those illiquid stocks if they truly believed in the underlying value.
It's almost like they're playing two different games with different sets of rules.
And Sleep, he was playing by his own rules. He also took aim at the pressure on institutions to report their performance all the time.
Every quarter, right. The constant pressure to show those short-term gains.
Exactly. And that often leads to short-term thinking, focusing on beating benchmarks rather than achieving real absolute returns.
It's like they're more concerned with looking good than actually doing good.
It's a bit of a hamster wheel. And Sleep, he saw right through it. He was always pushing for a more thoughtful, long-term oriented approach.
So a lot of what we've been talking about, it seems geared towards those big-time investors, people with millions to manage. What about the average person listening? Can they really apply these principles to their own portfolios?
That's a great question. And it's true, Sleep's letters weren't exactly meant to be a step-by-step guide for everyday investors. But I do think there are some key takeaways that anyone can apply, regardless of how much money they have to invest.
Okay, I'm all ears. What are some of those golden nuggets of wisdom that we can all take away from Sleep's approach?
Well, I'd say the most important one is this. Think differently. Don't just follow the crowd. Sleep was always challenging conventional wisdom, right? He was looking for opportunities where others saw only risk. Remember that cement company in Zimbabwe? That was not following the herd.
He was a true maverick.
Exactly. And that independent thinking, it's crucial for any investor who wants to beat the market. Another big takeaway is focusing on long-term value creation.
Like we talked about earlier, playing the long game.
Right. Sleep was always asking himself, what will this company look like in 5, 10, even 20 years? That kind of long-term perspective, it's essential for making sound decisions. It helps you avoid those short-term traps that can really derail your progress.
So don't get caught up in the day-to-day noise of the market. Think bigger picture.
Exactly. Focus on the underlying trends, the things that will really drive a company's success over the long term. And let's not forget about the importance of company culture.
Right, finding those companies with values that align with yours.
Sleep believed that those companies with strong, cost-conscious cultures, they're the ones that are built to last. Even if you're not a Wall Street hotshot, you can look at how a company treats its employees, how it allocates its resources, how it responds to challenges.
Those are all clues to a company's true character.
Exactly. It's like that saying, culture eats strategy for breakfast. Even the best laid plans won't succeed if the culture isn't there to support them. So yeah, think long-term, think differently, and pay attention to that company culture.
Sounds like a recipe for success.
Yeah.
And it's not just about making money, right? It's about finding companies that you believe in, companies that are doing things the right way.
Absolutely. It's about aligning your investments with your values. And Sleep, he walked the walk. He wasn't just talking the talk. He had some really fascinating examples of companies that were executing on those long-term plans.
I'm curious, beyond Amazon and Costco, who else caught his eye? What other companies did he see as doing things right?
Well, he talked about Dell, for example. He saw them as a company that was really disrupting the traditional PC market. And then there's Berkshire Hathaway, of course.
Oh, the classic. Buffett's company. Sleep must have been a fan.
Oh, yeah. He saw a lot of value in Berkshire's approach, especially with their subsidiaries like Geico and Nebraska Furniture Mart.
Yeah.
He was drawn to companies that were shaking things up, creating new markets.
They're not just sticking with the tried and true, but looking for the innovators, the disruptors.
Right. Like he was an early investor in AirAsia.
AirAsia, the Malaysian airline.
Yeah. They were this low-cost airline that was pioneering a new model in Asia. And Sleep, he believed in their focus on, remember, scale efficiency shared.
Right, passing those savings on to the customer.
He thought that would allow them to win big, build a dominant position, and, he was spot on. AirAsia became a huge success.
Wow, what a track record. It's amazing how he was able to see these connections From Costco to Amazon, a cement company in Zimbabwe, a Malaysian airline. What a mix.
It all comes back to that long-term value creation, that commitment to giving back to the customer. That was the common thread.
It's like he had this X-ray vision, seeing through all the noise and hype to the core of what really matters.
He was able to cut through the clutter and find those underlying principles, the things that drive success no matter the industry.
Inspiring stuff.
Yeah.
But Sleep's letters, they go beyond just pure investing, right? There's a lot more there, this deeper level of thinking.
Oh, absolutely. He was a deep thinker, always exploring new ideas, making connections between different fields. Like one thing he wrote about that I found really fascinating was this idea of slack in a business.
Slack, as in like not working.
Not quite. It's not about being lazy. He saw slack as having the time and resources to think creatively, to experiment, to pursue new ideas without being constantly pressured to maximize those short-term profits.
So it's about giving yourself some breathing room.
Exactly. He thought companies that were too focused on squeezing every last penny, they often ended up stifling innovation. They'd miss out on opportunities for growth.
It's like that saying, work smarter, not harder.
Yeah, kind of. It's about creating space for creativity, allowing people to explore new avenues. And it wasn't just theory for him. He applied it to his own life, too. He believed in making time for reflection, learning, personal growth.
Sounds like a pretty balanced approach.
Yeah.
Work hard, play hard, think hard.
And he gave a great example of this. He talked about becoming a governor of a failing school in southeast London.
Really? That's quite a change of pace from the world of finance.
Right. And it wasn't about making money. It was about using his experience to make a difference, to give back to the community.
Okay.
He saw it as an opportunity to contribute to something bigger than himself.
A chance to put his money where his mouth is.
Exactly. And that leads to another fascinating concept he explored, the idea of good costs versus bad costs.
Good costs versus bad costs.
Right.
Okay, I'm intrigued. Tell me more.
So he argued that not all expenses are equal. Right? Some investments, they might seem costly upfront, but they actually create long-term value for the customer and ultimately for the business. Those are the good costs. Then there are expenses that boost profits in the short term, but ultimately they damage the company's long-term prospects.
The ones that come back to bite you.
Exactly. He used the example of his partner's family business. They had this indoor activity center, and they discovered that customers were actually willing to pay more for things like cleanliness, good coffee, a friendly staff, more so than for fancy equipment.
Interesting. It's about investing in the things that really enhance the customer experience.
Yeah.
Not always the flashiest, most expensive options.
Right. It's about creating a positive, welcoming environment. And Sleep argued that this principle applies to any business.
Companies that focus on those good costs, the ones that truly benefit the customer, those are the ones that build lasting success.
Absolutely. And this ties back to company culture, right? The companies that understand this difference, they often have that deep commitment to customer satisfaction and that long-term value creation we keep talking about.
It's like they're playing a different game with different goals.
Exactly. Not just chasing profits, but building a sustainable business that works for everyone. But, beyond these specific ideas, Sleep's letters, they're just filled with these little nuggets of wisdom, anecdotes and concepts drawn from all over the place.
He was a curious guy, always learning and exploring.
Totally. Like in one letter, he talks about non-transitive dice. These are sets of dice where the odds of winning, they're not straightforward, even though each individual die is fair.
Dice. Okay, now you've lost me.
Yeah.
How does that relate to investing?
He used it as an analogy for the stock market. So just like any set of dice can win for a while, any investment strategy might outperform in the short term. Right.
Okay, I'm starting to see where you're going with this.
But true superiority, it only emerges over time. And it requires a deep understanding of how things work, the probabilities, the dynamics. It's a reminder to be wary of those short-term results. Focus on that robust, long-term approach.
Don't get fooled by beginner's luck.
Right. It's about understanding the nature of the game and having the patience to see your strategy through. And in another letter, he discusses scaling laws in biology.
Scaling laws, like physics and stuff.
Yeah. He explains how smaller animals, they have faster heart rates and shorter lifespans than larger animals, because of how their bodies scale. And then he makes this connection to businesses.
Wait, hold on. So is he saying that as companies grow, they get more efficient, like bigger animals have slower metabolisms?
That's the idea. He argued that as companies scale, they can do more with less, reduce costs, pass those savings on to customers, and that fuels more growth.
It all circles back to that scale efficiency shared concept.
Exactly. He uses Amazon as a prime example. They've consistently lowered prices as they've grown. Even though it might seem counterintuitive from a purely financial perspective, Sleep believed it was a key part of their success.
Thinking long term, playing the long game.
Always. It's fascinating, how he could draw these parallels between seemingly unrelated things. Biology, business, it all ties together somehow.
It speaks to his curiosity, that ability to make connections, to see patterns that others miss.
He was a true Renaissance man. And as his letters go on, you can see him wrestling with some even bigger questions, reflecting on wealth, the meaning of success.
Yeah, he doesn't shy away from the big picture stuff.
Not at all. In the preface he wrote for his collected letters back in 2021, he makes this powerful statement about investing and philanthropy, about how they're connected.
Oh, that's something I wanted to touch on. He seemed really passionate about giving back. It wasn't just an afterthought for him.
You're right. He believed that good investing and philanthropy go hand in hand, that using your wealth to reinvest in society, that was a more meaningful way to live. Seeing wealth not as an end goal, but as a tool for creating positive change.
That's a powerful idea. It really challenges the traditional definition of success, doesn't it?
It does. It suggests that true fulfillment comes from using what we have to make a difference.
It's about more than just building a bigger portfolio. It's about leaving the world a better place than you found it.
Absolutely. It's recognizing that we're all connected and our individual success is tied to the well-being of the community, the world as a whole.
Wow. So, after spending all this time with Slave's letters, what are your big takeaways? What do you think are the most valuable lessons he offers for investors and maybe even for everyone?
That's a great question. There's so much to unpack, but I think what resonated with me most is that successful investing, it's not just about numbers, right?
It's not just about picking stocks and hoping for the best.
Right. It's about having a sound philosophy, taking that long-term perspective, and constantly learning and adapting, thinking differently, challenging those assumptions, and having the patience to see your investments grow over time.
It's about playing the long game, but with intention.
Exactly. And ultimately, it's about aligning your financial goals with your values, using your resources to make a positive impact on the world.
It sounds like Sleep's legacy goes far beyond just his investment returns.
He left a blueprint for a more thoughtful, purpose-driven approach to both investing and living.
I'm so glad we got to take this deep dive into his letters. It's given me a lot to think about.
Me too. I really encourage everyone listening to check out the letters for themselves. You can find them on the website for Sleep's Foundation, the International Geophysical Year, at igfoundation.org.uk. They're a real treasure trove of insights, and I guarantee you'll come away with a fresh perspective.
And that wraps up another deep dive. Until next time, keep learning, keep growing, and keep investing in yourself and the world around you.